Hello, Namaskar, Sat Sri Akal, Vanakkam. Wish you all a very happy 2024. Welcome to a very special episode on Oh My Finance. We meet at a time when the world is looking towards India, or shall I say leaning on India, which stands out as a major engine for global growth. By all measures, 2024 looks like a watershed year, or shall I say a breakout year. Household consumption is back and how markets are galloping towards record levels. The broader economy has shown strong signs of staging a smart rebound. Footfalls are back in malls and neighborhood arcades. Car sales are rising. So, what's the glide path going to be like so far as markets, equity indices, the broader economy, and related areas are concerned? What is it that we need to watch out for? What are the key sectors that are going to stand out? And importantly, what are the challenges and known unknowns that we should keep an eye out for? To talk about all of these and much more, I have with me two distinguished gentlemen who knows about all of these like the back of their palms. It is my privilege to welcome Dr. Harshvardhan Raghunath, Non-Executive Independent Director, Karur Vyasa Bank, Independent Business Advisor, former Senior Advisor at the Bain & Company, and a long list of accomplishment in a long and distinguished career. I also have Srinath Sridharan, Independent Business Advisor, Strategic Counselor to a large number of corporates across diverse sectors, and a very popular columnist and commentator. Delighted to have you, Srinath and Dr. Harsh.
Thank
Dr.
you.
Harsh, first to you. There's an unmistakable populism about India, optimism about India. There's hope, and the world is looking towards India to take the world economy out from a very shaky, uncertain prognosis. What is driving this optimism?
Yeah, so I think my own view is that the optimism is much stronger domestically within India, and the perception that therefore the world is looking at us than probably what the world is actually looking at us. And I think the world is looking at India for a variety of reasons. We are the most populous country. We are the largest, fastest growing, at least recently the fastest growing of the large economies. And so both these things obviously positions us as a preeminent nation in the world. I think we have equally got benefited with the decline of China, decline in the global perception, not decline of China as a country. Because of everything that has happened in the last, in fact, if you went back last 30 years, the catchphrase was the silent rise of China. What you've seen in the last 4-5 years, it's not silent anymore. Yeah. And even the rise is not as fast as it used to be. So that decline, I think, has helped India, which is that, so what next? Sort of the question. So then the most populous country now, the fastest growing, obviously is India. So that is what is attracting. And to top that, we have a very strong democratic tradition. We have some degree of policy continuity. All of these things from at least investor standpoint makes India attractive. You look at elsewhere in the world, leave aside US, but Europe is in pretty bad situation. I think US has, in my opinion, has a generational problem. Yeah. Japan still struggles to come out, declining population. So where else in the world we have large economies which hold some promise.
That's right.
And which are politically palatable to the Western world. I think therefore there is an optimism about India.
So India finds itself in a very sweet spot, and it's only up to us to squander.
Absolutely. Absolutely.
Srinath, if you look at the markets, and that's the most visible sign of transformation and also the most visible symbol of optimism that is probably sweeping the Indian economy today. The markets have given a 70,000 plus salute to this optimism. If I were to ask you, where are the markets going to stop in 2024? Would you like to take a punt?
Yeah, I mean, what we've seen so far is a lot of exuberance. And I think that comes from what I call confidence of consumption. Mm-hmm. I think probably I'll be a little pragmatic and say we need to pause because there's a lot of FOMO involved in this exuberance as well. We've had lots of new investors entering the market the last 2-3 years. And a lot of it was also during the COVID lockdown. They didn't have any other financial avenues and the disposable income, which has come into the equity market. I think that confidence should not become overconfidence at this point in time.
Yeah.
We have to be pragmatic. We are not loners amidst the rest of the global economy. We do have our own set of challenges. Our economy has grown aggregate, but it doesn't mean that it's the same growth for everybody rich or famous or the poor or the SME or the MSME or so. So I think we have to break it down into saying that are each of our consumer segments growing, and is it sustainable growth? And I think the lesson for us from demographic point of view is some of our investors have never faced a loss. You and I, because of the generational issue, have faced losses. We have seen cycles, and some of our new investors in the markets have not faced a loss. And I think that pragmatism is what I would hope for. Am I bullish? I'm positive, but not bullish. I think this is the year where I think as a country also we'll have to do a lot of consolidation, fiscal consolidation, because the global economies look a little gloomy. And I think the answer is going to be a lot of our consumption, and can we drive those consumption?
So, to an investor, to a retail investor, your advice would be ride the exuberance, but hold on to the horses.
That's right. And if you're investing, you should also know the risks. It's not as if the market is going to go only one way and that's up.
That's right.
Markets have seen volatility and cycles. And there will be cycles of whether it is DII or FII coming in and pulling out. That will happen all the time.
Dr. Harsh, carrying on with the same point, if you look at the markets, for instance, and if you take markets as a marker for which way the economy is going, that is generally taken directionally, at least, that what the markets do today, the real economy probably will do 6 months later. And also you touched upon the point that India is emerging probably as an alternative to the China plus one strategy for the rest of the world. Do you expect large slices of global money to come into India over the next 12 months and take markets to a completely different level?
I'm not sure. I don't understand markets, so let me state that up front. But in terms of global money flowing in, it's entirely a function of interest rates. What we saw 2022, something like 1.6, 1.7 lakh crore went out of FII money. All of it came back in 23. And almost all of it came in the last quarter when the rates started falling in the US. We are globally in uncharted territories. We haven't seen for the last 50 years such sharp interest rate rise. Capital is a function, capital flows are a function of rates primarily. And so if the rates remain elevated, which I personally believe that I don't see a rate cut in the US in the first half of next year, calendar 24, despite what others may be saying, then I will be skeptical about if the US rates are at 5% Fed rate, why would capital go elsewhere? So unless by some set of unexpected reasons, if there is a sharper rate cut, then yes, you might see foreign money. But you have to bear in mind a lot of Indian equity market rise has also been on the back of domestic, these 18,000 crores or so per month SIPs into mutual funds is really as much actually more than the FII flows. So the recent rises in the market has been on the back of domestic capital. Whether that sustains and all is another question. And I think some of it will sustain. I think what has happened, to take forward the point Srinath made, I think COVID was kind of a pivotal event for capital markets. I think a couple of things happened. One, people got used to using online methods of investing, be it apps or so on, both in stock market but also in mutual funds and so on, because we are forced to do it in one way. And therefore what you're seeing is a bit of what I call democratization of Indian capital market. You're seeing folios coming out of UP, Bihar, etc., which you didn't see. I mean, it's well known, right? Like 85% of the AUM in mutual fund came out of 10 cities. Yes. I think that's kind of spreading a bit right now, which is in a broader sense a good trend. I don't know how long it will sustain, because we haven't seen a downturn in stock market since this phenomenon began. And when people actually make losses, when you are really tested. And so a lot of these new investors who have come in haven't yet seen losses. We have seen volatility, but we have not seen a secular downturn.
Absolutely. Now you touched upon a very interesting point, and there's some fascinating data that has come over the last 1 year. The Indian equity market added around 15.69 million investors so far in 2023.
New investors, you mean?
New investors. These are incremental new investors. And who was leading the stack here? Uttar Pradesh.
Yeah.
With 2.31 million. it had actually outgrown Maharashtra, the most financially savvy state in India.
Correct.
Although Maharashtra retains the largest investor base with about 14.9 million, but Uttar Pradesh now stands almost shoulder to shoulder with Gujarat. Now, this clearly is a sign of deepening. Do you think this is a sign of change, sociological change, people moving more towards financial?
So I would hold my horses to call it deepening. It's broad basing. Whether I'll call it deepening if it sustains. But it is also a generational change. I used to often, when I used to do consulting, I used to say that Indian finance will change when the 85 born turn 30, which is other way of saying 2015. Because that generation is very differently disposed to using third-party investment advisors. So that's change has been. Actually, this trend began in 2015-16. So when these millennials so-called started coming into investing age, they crossed the age of 30. It's too early to call it a deepening, I would say, but it's a good sign. I think in the long term, even half of it sustains. I think it's a good sign.
Sri, do you think this is something that is sustainable, and do you think we should generally take it as a positive sign?
It's a positive sign for sure. Sustainability, I think the jury is still out. I want to give another, let's say, financial product. I think the powers that be may not like the word financial product, but crypto. I mean, amount of crypto folios during COVID lockdown in India was phenomenal. I mean, you might argue that the average ticket size was as low as 200 rupees, but we've added nearly 1 crore of crypto folios only during COVID lockdown. India is probably the third largest number of folios in the world for crypto investments. So are you telling me, so this is to Harsh's point, I think people are also experimenting. The millennials and the Gen Z are experimenting. So if you look at the broad Indian demographics, about 65% are less than 35 years of age. So what I call the GEMS phenomena, the gig economy, millennials and Gen Z, they are actually going to stress test each of our markets and sustainability of how they see the long-term one. And I think that is where the challenges to the regulators are also. Because regulatory framework is expected to offer consumer protection. And I always have this worry, if the customer is greedy or using FOMO or stupid, how can I blame the regulator for not protecting myself? But democratizing, I think if SEBI actually brings the SIP amount to as low as 250 rupees, I think we might see more folios coming in. But what happens in one single market crash, one day people lose some money, will they stay invested?
Right.
And I think we also have to look at it as, in the last 2-3 years, the real estate markets in a lot of pockets had come down and they're rising again. And the younger population does not own assets. So are we seeing money which would have traditionally gone into mortgages going into financial assets? That's a question to wonder.
Do you think real estate as an asset class is now regaining its attractiveness?
If you look at Bangalore, NCR and specifically Hyderabad, predominantly IT hubs, if you look at the data from 22 last quarter onwards, the number of houses that have been sold less than about 70 lakhs has started increasing.
Right.
Very coincidentally, about 60% of the population seems to be what we are saying the millennials and the Gen Z investing there.
Interesting, because I was just scanning through some proptiger.com, housing.com data, and 2023, their research says that about close to 40%, that is about 4 in every 10 houses sold, particularly in Mumbai, Pune and Hyderabad, was in the 1 to 3 crore bracket. Mumbai, Pune and Hyderabad continue to remain the outliers. There's a pulling growth. But there are also a large number of micro markets that are developing within these regions. So clearly, it is a function of two things: more spending ability, and also probably people's confidence, because house buying is a function of your ability or how confident you think that you're going to be able to fund it over a 10 to 15 year period. Don't you think so?
One of the things that has happened in the last probably 15-20 years, but more pronouncedly in the last 5-7 years, is housing finance is now it's available across all income segments, so-called affordable housing and so on. It's available at a reasonable rate. It's one of the cheapest source of borrowing you can make. And it's widespread. So yes, it's a combination of all of these factors. But I think the role of finance is actually quite crucial.
And you think how real estate as a property has regained its attractiveness as a...
It's not something I study, so I wouldn't be able to comment. I mean, purely demographically, at some point of it, we still are growing our population at 1.3% net. So we would need more housing units. 1.3% of 1.4 billion is a lot of people, a lot of new families. So we will need housing units. And you are right. I mean, admitting that I am not at all even a student of real estate, my own view is that there is no such thing as Indian real estate market. Each market has its own dynamics.
That's right.
So there is a demand supply for houses in Juhu, which is distinct from that in Bandra. So I think it's only micro markets that you can talk about when it comes to real estate. That's my limited view.
Sri, one of the things that needs no emphasis is that clearly on a secular basis the markets are going to go up and in India. But if I were to ask you that which are the top 10 sectors that probably are going to be the major engines for growth, what would you say?
So I would say predominantly infrastructure sector, which means that any allied industries or downstream, which is iron, steel, paints, cement, all of them are going to grow. Financial services. I think as we move into financialization of assets and markets, we are going to see more financial services grow. And again, their banks, whether it is fintechs, they will come into play, and others, these two. I see a huge aspect. The third one I would bet on are some of the interesting PSUs. I mean, there's a kind of a overhang on PSUs. I think it's time that we kind of dispel those. You look at, let's say, a Concor in a PSU, there is a unique value that adds to its segment. Yeah. So some of the PSUs are very, very, I think they're aiding to the economic engine for growth. And I think if India continues with not just building infrastructure, but saying that I want to build new cities. Yeah. I mean, the entire Delhi-Mumbai industrial corridor was supposed to build about 50, 60 new cities of economic activity. I think that's where my concern stems. If we don't build newer cities of economic activity, we are going to have the same problem of deep urbanization in the top 10 metros. Yeah. And what happens to the rest of the country? I mean, you have these broad highways being built, but are we going to use them? Are we going to build cities along? Are we going to create newer quality of life? So my bet, infrastructure, financial services, and some of the PSU entities as well.
That's right. Dr. Harsh, are you as bullish as Sri on PSU banks?
No.
Why is that?
So this is one sector I know somewhat well. Look, the issues with them are very deep rooted. And they have to do with the institutional context in which they operate. That stems from government ownership and so on. So in a competitive banking market, I just don't see how they could compete unless there is a very fundamental change in the way government manages them, and I don't see that fundamental change happening. And the reason that will not happening because there is, and I've said this before, that there are instrumental benefits of having these banks under government ownership for both the political and the bureaucratic class. You can run schemes and so on. So nobody is going to let go of that. So I don't see meaningful privatization happening. I don't see meaningful change to the governance of these banks happening in the next. I think the government did consolidation, which was a great step, at least the beginning. But the next steps are much harder in order to actually improve them. And I don't honestly see them happening. I will be happy to be proven wrong. And so I think this unevenness would remain in the way the two types of banks function. There is a broader issue there, and which is something I have written variously about. See, Indian banking is the only sector I know where entities constructed under very different laws operate as equal. So PSU banks are under their own Nationalization Act, State Bank has its own law, private sector banks are under Companies Act, cooperative banks are under Cooperative Act, foreign banks are under RBI regulation, they are not companies. Where else do you see this? And these are not just differences which are minor. They have profound implication on the governance of these banks. And I've been saying that the easiest thing to do is to bring them all under companies law. They make them companies. Force foreign banks to incorporate in India. Because that will at least establish some bare minimum standards of governance. Everybody.
If you bring them under the Companies Act, then where does the regulatory buck stop with the RBI?
Well, I mean, how is RBI regulating private banks? They're under Companies Act.
Right.
But it's regulated by RBI. There are many sectors. Oil is a sector where there are Companies Act company, but there is a regulator there. Or I don't think regulation changes. In fact, what you do is you get another oversight of company law. See, today there is no company law oversight on public sector banks, on foreign banks, on cooperative banks. They don't have to have board of directors as the company law describes. And that creates a fundamental uneven governance.
Let's move towards, say, fintechs, the new class of banks, if I may say so. 2023 probably was a year of reality check for fintechs. Now they have to get used to functioning and operating within regulatory boundaries. Until now, there were very little regulation on a comparative scale so far as compared to banks. Where do you see fintechs now? Because fintechs at one point were emerging as the poster children of the Indian startup community. That seems to have tempered down a bit, isn't it?
Yeah, so I have a bit of a cynical view on fintechs because I have seen Indian finance for 30 plus years. Look, finance has been using technology for as long as we remember. Banks were the first to adopt IT in a large scale in 50s and 60s. So there's nothing new in this. I think what happened and what got this hype created is a bunch of things. It's easy access to computing, it's mobility, it's mobile phones becoming widespread. And therefore, what effectively happened is that means of accessing customers changed. Fundamentally, that's the change that has happened. And that's why you see the biggest impact of so-called fintech has been in payments.
That's right.
And what people discovered last year is that just because you can get 10 million customers doesn't mean you can make money off him. So payment is one example where nobody has ever made money, and nobody will ever make money, if you ask me. And that realization struck that, just because somebody claims that I have X million customers, it doesn't make it a viable, sustainable, leave alone profitable business model. And therefore, what are all these doing? They're saying, oh no, I have to start lending. So I will become a DSA for some lender. But then there are a million DSAs around. So you are a DSA with an app. So my view is that effectively and all of this was happening because all of them had almost infinite line of capital from their capital provider, who themselves had an infinite life of capital with interest rates very low. So as interest rates started changing and capital became more expensive, then people started asking questions that they should have asked when they invested in the first place. Where is the viable business model and so on. So I think that's the reality check that has happened. And I think it's actually very good because there will be cleaning of this space that will happen. I mean, there's far too much fly-by-night kind of operators in this space who could get capital very easily.
That's right.
Because there were fly-by-night capital providers. So that whole ecosystem is being cleaned now, and I think it's a very good sign. My own long-term view is that Indian fintech will only survive and thrive in partnership with regulated entities, with banks and so on. I don't see standalone them building viable models.
That's right.
So they will have to become service providers to banks. And that we are seeing that a bit happening in the co-lending model and so on. I think there are multiple other areas where that will happen. And that's the only long-term equilibrium setup that I set. I don't see them standalone thriving.
Sri, you agree with this line of thinking, and also as a supplementary to that, we saw a lot of IPOs in 2023 and probably a lot of fintechs because of the capital providers. We'll also have to, toe the path of profitability and eventually have to get them listed. But we saw that one of the biggest fintech companies when it got listed was also a bit of a reality check for that company. It has still not reached the price levels that it had offered. Do you see fintechs actually getting into collaboration with regulated entities like banks to survive and also at some point thrive? And do you see a lot of them hitting the IPO bandwagon in 2024?
Sure. I think multiple segues there. I mean, one, I think there is no substitute for profitability. Unfortunately, the fintech community in India has very smartly used a word called pivot. Basically, my core business is not making money, so I will now try, as Harsh said, let me do lending. So lending seems to be the last resort of all fintech businesses. Whether you're in payments, insurtech, whatever you do, you believe that that's the only way. And I think there's a consumer behavior angle, right? I mean, as consumers, if you're going to borrow money, your behavior is almost subservient or very different than if I have to ask you for investing your money in the markets. So consumer behavior is very different in the lending space. Two, I think fintechs have a big challenge. If you're not going to be regulated, you won't get the respect. It's as simple as that. The only point of divergence from Harsh's view I have is, at some point in time, we may not be averse to seeing, let's say, a digital bank, which means a fintech itself emerging into a bank. And the reason why I'm saying it is, I don't think co-lending packs will survive. There is nothing called equal partnership.
Right.
I feel that one of the partners, whether it's a small bank or whether it's a smaller fintech, one of them have to be almost subservient. 2016, that was the genesis for a lot of these behavioral changes, and COVID kind of accelerated it.
Right.
And a lot of those fintechs, when they went to banks to raise money, the banks were trading at far lesser valuation multiple than the fintechs themselves. So they kind of missed the boat. And now I think the tides have reversed. So I think it's an unequal equilibrium, so to speak, in the market. And it's going to be like, who's going to blink first? The banks or...
We've seen that in the case of Slice and Not a Small Finance Bank, where that capital actually for the survival, if I may say so, of a small finance bank, which is a regulated entity, came from a well-capitalized fintech, which probably was not profitable, I would not know. But a fintech coming to the aid of a regulated banking entity, does it signal some kind of a trend that you think is only going to get accentuated?
No, I don't think we should read it as a precedence. I think RBI tried to solve two problems with one merger. The fintech also was in problem because it did not have a business model. It was floundering. It was well capitalized but bleeding heavily. And with RBI's card on file and credit card rules, all that coming up, that fintech did not have a sustainable business proposition even to exist. And it had a banking problem. And probably RBI felt that if they merge, and if I'm assuming they would have done their fit and proper and felt it, and look at it from RBI's perspective, even if this merger fails, at some point in time they will pick it up and give it to another bank to merge it with. Right. So it has solved two problems for them in one go. So I don't think it is a precedence model for fintechs coming to a bank's aid at all. I mean, we shouldn't jump that gun. I mean, that presupposes that the fintech has a better intelligence, better business model, and better consumer engagement. None of this.
That's true.
None of those. The business model is extremely very different of the bank. The customers it serves is very, very different. And end of the day, according to RBI, they've brought now a CEO who's an ex-banker to run that. You're not allowing the fintech to run that particular bank. The shareholding is very different, but the actual operations are going to be a banking professional or professionals running that.
Dr. Harsh, let's talk about interest rates, and there is heightened anticipation that interest rates will start falling in the US, maybe in a quarter from now. There has been some signaling from the US Fed Reserve. Do you see that happening anytime soon?
So what has happened is that bond market has read too much into Fed's announcements. What the Fed said basically that we think the hikes are done. I think if my own read is, so that's where the 10-year US moved from 5% plus to less than 4%. It's back to 4% now. I think bond market just ran ahead of itself. My own sense is that given where the US job market is, I don't see first half of calendar 24 US Fed cutting rates. They have no reason to. They are growing at 4%. Employment is red hot. Why would you cut rates? So I just don't see that happening. Second half, I don't know. It depends a lot on what happens in between. Inflation US is, by the way, coming down. So they are doing the unthinkable soft landing as we. So I don't know what motivation would they have to cut rates. They may not hike them, so that's fine. But I don't see first 2 quarters of FY24 US rates being cut. Not in India. Just to jump your next question. Because in India, look, this is an election year, right? My back of the envelope is that, there are 540 seats that will be contested. You assume a 50 crore per seat spend by everybody, the parties, the government. It's a 27,000 crore fiscal boost. That will be so inflationary. It will be very widely distributed. And so therefore there is a hidden inflation pressure. And on top of that, if the US rate don't go down, I think even there will be any incentive to cut Indian rates. Right. So my own view on Indian policy rates cut, that is, I would probably at best assume one cut towards the end of calendar 24.
Right. So a status quo on interest rates which are high at
this at least the first half is where I would place it.
Absolutely. Sri, a status quo on interest rates, one, do you agree with that until say the end of 2024? And if rates were to remain high for a long period of time throughout 2024, what does it mean for banking stocks?
So I think two aspects. One, the calendar year is also a leap year. We'll have to be cognizant that there are 40 countries, including India, which are going for elections this year. One single country, including the US. So US will start its campaign the mid of the year as it goes along. So there is going to be a large electoral economy that kind of plays out, not just in India, most of the countries. I think coming back to your question, I think the rate hike, what about inflation? We are not even questioning the inflation because a lot of the MPC decisions also have to peg inflation as a base. So my sense is by the time we hit the June, July when the elections are done, are we going to see a rise in inflation? And that could be a pressure also. And the usual pain point of monsoons, yes or no. I think we're going to wait till what we see there. Two, I think, can we drive sustainable economy apart from electoral economy? I think that's going to be the pressure in the first two. You're already seeing the FMCG kind of facing pressures in the volumes. The volume builds have been struggling. They're seeing volatility in FMCG pricing as well. The margins are under pressure. Commodity prices are rising. So that is again a barometer of how people are going to do it. And end of the day, all these are getting financed by the banks. Right. And more importantly, to Harsh's earlier point about the PSUs and cleanup, and we're also seeing, let's say, the bad bank, NARCL, struggling. It's not able to, just to remember that it had promised to accumulate 2 lakh crores of bad loans, and it has just done about 11,000 crores. Yeah. Despite all the governmental might, pressure, everything, it's struggling. Whereas you have a private sector ARC segment, which we thought was not useful.
It was a bad idea to begin with.
Yeah, bad banks.
So you alluded to elections, and it happens every 5 years as a fiscal boost, and it keeps on rising because of inflation. How much of there's a lot of talk that the party in power is going to come back with probably a bigger majority, if not the same majority. But if just to take a contrarian view, if that does not happen, or if that were not to happen, how much of a shock will it be for the economy?
So I distinguish between the stock market and the economy. Yeah. And my own view is that, and I don't understand politics at all, so I don't know what's going to happen in the election. But my own sense that the stock market had priced in the current regime's continuation after the state election. Right. That's when we saw that bump up. And therefore, I don't see if the current government wins back majority, that there will be a significant boost up, because that seems to be priced in already. Yeah. And if it does poorly compared to what the market expects, then there might be a downward pressure. And that by that I mean not that they don't come back to power, but they come back with less majority and so on and so forth. So that could happen. In terms of our underlying economy, I think large part of our economy is honestly immune to the change of regime in a short period of time, in a period of 1 or 2 years. I think governments tend to have much longer term impact. And so I don't see the trajectory changing in the next couple of years, no matter what happens in the elections. For a large part of economy, there might be isolated sectors and individual firms that might get impacted in terms of perceptions about that. But I think the economic momentum should continue because I just feel that the structure of our economy is such that it's in the short run is not really impacted that much by the whole economy, by the change in political regime.
But individually and personally, like the markets, have you also factored in a return of the party in power with a similar majority?
As a personal individual investor, no, that's not what I think of when I invest. In fact, to your earlier, I didn't comment. I don't even look at sectors. See, my view is that you make funds on firms. Yeah. I did a very interesting analysis. You take top 10 sectors in India and look at all the spread of firms. What you find if you look at basic economic measure, like return on equity, return on capital employed, the best and the worst firm difference in any individual sector is way more than the average between the sectors. Right. Which means that the performance is much more diverse within a sector than across sectors. So I just don't see much point in doing sectoral bets. I always look at firms. And yeah, I mean the firms that I invest in, I feel are immune to political regime change.
That's right. Sri, there is a bit of an enigma, a bit of a paradox that we have seen over the last 12 months. The rupee has fallen, even though the Sensex and Nifty has actually catapulted. What explains this cautious FPI approach?
See, I think so. Sorry, go ahead.
No, sorry.
No, I was going to say, I think we'll have to see it outside of RBI actions. We'll have to see it outside of stock market. We'll have to see outside of what I call the euphoria and the jingoism. We keep saying that India is shining, India growing, Indian economy is bubbling. That's fine. But end of the day, let's face it, dollar is the global reserve currency.
Right.
We will have aspirations towards it. We're doing deals, bilateral deals with different countries to bring rupee as a transaction unit, all of that. But I think we are a few years away from it, that rupee will face pressures. It depends on our balance of trade and the exports or the imports that we do.
So you don't think that a de-dollarization, as much as we would like to have, is going to happen anytime soon?
No.
If you look at I looked at this data some time ago. If you look at between 1990 and 2020, the share of dollar-denominated trade globally went down from like 90+% to about 70. Yeah. But it's been there for a while. It's still the most dominant country, and I also don't see it going anywhere. And look, to your point about rupee falling, in fact, I'm surprised it has not fallen enough.
Yeah.
If the US rate went from 0.5% to 5%, I mean, rupee should have been at 90. Or maybe even higher. I think the reason we have held up much better compared to many other countries is because we have continued to get FII flows. Our reserves are still very strong and so on. And I mean, if you really look at the movement in US 10-year from 0.5% or 75 basis points to 5% versus Indian 10-year, which moved from like 6% to 720 right now or 730, rupee should have gone down even more.
That's right.
So I'm actually very happy that rupee hasn't gone down so much.
But do you think the fair value of the rupee is around 90?
I don't know what the fair price is. All I'm saying is that if you purely look at interest rate differential, you could have actually expected rupee to fall much more than it has fallen.
Sri, where do you think the fair value of the rupee should have been now?
So I'm not an expert on that, but I think I would agree. I would have thought it would have at least fallen to 86, 87. It was sliding, right? We went up all the way to 83 plus, and we thought it's going to slide further. So which is where the RBI action of pumping in money and buying the dollars kind of, I think they propped it up. And again, while I see the independence of the authority, they also are the debt managers for the country, RBI. So while a lot of people will attribute political reasoning for it, I think it's not political reasoning. It's a pure mandate that they have. The debt manager of the country, you need to balance your rupee versus every other currency in the world.
And the same question to you, which I asked Dr. Harsh a few minutes ago, is how much of a shock will it be for the markets if BJP will not come back to power?
Okay, theoretically, I think if they don't come back, could we see 10 to 15% down in the stock markets? I think probably yes. Unless we have a very fractured mandate where it goes into a coalition government with parties that you can't even think of as we speak today, which means that are they going to impact on any freebies that they will have forcefully give? And what is that impact? And even assuming there's a lot of freebies given, I think the economy, if you look at the overall budget, union budget, what will it be? 4%, 5% differential? I think India can kind of take that. The markets might dip if this government doesn't come back, 10, 15%. But I don't think the economy, we are not going to turn back from a lot of things that we have done. It also depends, I think, somewhere pragmatically, again, I'm not a student of politics, but as a citizen, if you look at it, I think a lot of energy in this particular government over the last decade has come from, you see the leader and the energy and what we have done phenomenally geopolitically with global relationship. I think at some point in time, we must confront, when I say we, I'm talking about the party and the parliament, who's going to be the next leader? Because the current leader is aging and they have 75 years, they will turn Margadarshak. So I think that phase, I think that is the time when I see a milestone of how the markets would react.
So that's around 2025.
2025, yeah. So today, I think the market is priced in that BJP will come back to power. So if they don't, it will be a surprise. But 2025 movement, succession planning, like in the corporate world, how is the market going to take it and price it in? And will their policies, especially the economic policies, continue? I think that's a larger question that we need to ask.
And if you look at the recent market dynamics, there's a noticeable trend of small caps and mid caps are outperforming their large cap counterparts, particularly in industries like infrastructure, real estate, etc.
That's because of SIP. If you really look at the SIP flows, and I looked at it some couple of months ago, 45% are in mid small cap funds. This is what the advisors are peddling. Yeah. And so that's exactly the function. I don't necessarily see that reflects any
consumer choice
or any deeper buoyancy in those sectors or those kind of firms. It's just where the capital is moving right now. It could as well turn around next 2 months for all we know. See the market. What happens in India is that the floating stock is so low in some of these companies that you put 50 crores into companies, the stock goes up 30%. I mean, especially in the small and mid cap.
Right.
50-60% is owned by the promoters, and so the floating stock is just very, very small.
That's right.
So small amount of capital going into them can see great amount of returns.
Final question to both of you, also related to China. It's in well, imploding would be a stronger word here, but it's clearly going through a bit of a massive reset. How does India benefit or get impacted by this?
You go first. So I think there are many probably drivers of that, and very importantly, many lessons for India in that. And my view is that there is just an underlying demographic momentum. So we've seen, if you compare countries, that the moment the countries hit median age of 40, it's very hard to change economic trajectory, which happened to China. And that's why you're saying there's growth just kind of arithmetically comes down. And then what they have done is, for whatever domestic or other geopolitical reason, this whole stridency in their international relationship, I think this whole silent rise of China has gone away. And that has sort of vitiated the international perception of them. And I think so therefore trade is going to fall. We are going to see deglobalize. We are already seeing, and that hurts them more than anybody else. Now, what are the lessons for us? So I think our median age right now was 28, and I keep saying this: by our 100th year of independence, we will hit 40. So we have about 25 years to do whatever economically we'll do. In fact, I just said it in another podcast that today our per capita income is about $2,200.
Right.
If you are to go to 8,000, which is not even the higher income, it's like the middle of the middle income, then our GDP growth has to be between 6.5% to 7% for 25 years. Other than China, no other country has pulled that off. Otherwise, we are condemned to remain a low income or low middle income economy forever.
But do you think we can grow at about 6.5%?
So there, my view is that there are, and you have to allow me 2-3 minutes on it, there are some deeper fault lines that we have to address in our economic terrain, if you will. One is appalling women's participation in labor force. If we change that, we are going to not be able to do that on the back of men. We just don't have enough of them. So to my mind, I keep saying this is not a social and moral obligation anymore, it's a brute economic reality. If we don't get more women to work, we are not going to get there. Second fault line in my mind is, you touched upon it, but we didn't discuss, which is this rampant urbanization that's taking place, which is unplanned. If you drive within 40-50 kilometers of all metros, you see these humongous urban agglomeration, urban sprawls that are developing. And they're sort of in this public infrastructure limbo. They are neither gram panchayats, not in the metropolitan. I don't know who's going to provide them public services, transport, sewage, water, health. And the risk we run is that they'll become cesspools of then crime and bad health and so on and so forth. So I think and I honestly don't know what policy, if there is any, that we are pursuing to control and do a planned urbanization. Because it has economic benefits, but it has to be planned,
right,
which China did, for example. China constructed 50, 100 cities, but in a fairly planned way. And they had the authoritarian setup to do that. In our case, it gets caught between state, subject, local, central, and so on. Third point, I feel that we have done a horrible job of primary education, primary health. We have allowed what I call a very deep backdoor privatization of both of these. State has completely collapsed. And in the long run, for sustainable economy, you need much better quality primary health and primary education.
Right.
I don't again know. I mean, if I'm reborn as a policy maker, these are areas that I would love to work on today.
Right.
Because this require actually, they are not to be solved next year, but this requires sustained action for the next 4-5 years. Yes. North side, south divide. I don't know how we are going to plug this. It's growing every year. Layer on that the entire challenge of energy transition, climate change, which by the way amplifies all the first 4 things that I talked about. It makes urbanization worse, it makes women's situation worse. There are even studies on that. So I think these are all deep fault lines, and a lot of them you see how China handled. We don't have some of the instrumentalities that they had of authoritarian rule and so on. We have to solve it very differently, but we still have to solve. So my own view is that that's what our challenge in the next 25 years is going to be till the 100th years of independence, if you
But
will.
if manufacturing, global manufacturing were to reshore outside of China, do you think we are...
Well, and I completely agree with the argument Dr. Rajan has made in recent book. I haven't read the book, I've read reviews. I don't know why we are obsessed with manufacturing. Number one, there is not enough economic value left in it. Yeah. Secondly, there are 10 other countries we are competing with. A lot of them have better proposition than us. And therefore, I think we need, and the third thing is that we ignore the fact that we have humongous domestic demand. So this export-led model could be useful to us, but we can develop a domestic economy-led model. That is not a choice Vietnam has, with the population it has and so on. That's not a choice Philippines has, but we have that choice.
That's right.
So I just feel that over-obsession with the export-led manufacturing could distract us from services, distract us from doing better agriculture, distract us from domestic-oriented kind of industrial base. We have enough. Look, if you raise our per capita income to $8,000, there will be so much domestic demand that we don't have to export. And the last thing is like one lesson that the world will learn from China, of now, is that they wouldn't want to create another China.
Yes.
And therefore, nobody is going to put all their eggs in the Indian basket.
Right.
And so I think we have to learn from all of this.
Sri, what are the advantages we can get if China slows down? How does it help India?
So I think I have a fundamental policy thinking issue. We seem to think that it's only binary, that it's China. If we are competing with China, we must hate China. As Harsh had pointed out, there are lots of things they've got it right. And there are things that we can learn for what I call the urban policy planning. We just don't, our cities are unlivable. Yes, we can take great...
We are creating more of them.
We are creating more of them. Unlivable cities, unhealthy cities. We don't have primary healthcare. We don't have primary education. For example, NEP, despite the double engine that we speak about in politics, the states where the same party rules, they have not been able to implement NEP. So this was launched in 2020. We are in 2024. So when are we going to get our Education Act right? Because you have to then give it about 15 years for it to start giving us benefits. So a lot of these fundamental things which are what I call jargon-based terminologies that we create and throw it out. Let's learn from China. Can I have every city I develop, can it be self-sufficient across all the public services that we can do? Our fundamental flaw is also in the pricing of public service. Are we pricing water, electricity, sewage services right? And I'm also very pragmatic that government also has a role to price it in such a way that the rich can pay better, the better cities, and you also have to subsidize for the poor. But we don't even price. The fundamental flaw for climate change narrative about water is we are not pricing water at all. And there are enough studies to say where we are flawed. So if we don't get these right today, as we start building more poorer cities, flawed. China narrative, very simple. We don't have to compete with manufacturing just because that's the machoism. We don't need to prove India machoism anymore. Yes. And I think China, what they built, what I would learn from them is 80% of the GDP comes from SME and MSME. Yes. We have 11 crore SMEs in the country. And our contribution to GDP is far below 1/4. So can we move that needle? But again, structurally, our banking system is not geared towards SME and MSME. They're geared up towards the corporates and the government businesses. So where will they get access to capital? And every year it's a narrative. Every budget there'll be some scheme announced, 5,000 crore, 2,000 crore a year, and incremental growth. SIDBI and NABARD, I kind of question, and Harsh and I keep chatting, saying, can they really be path-breaking global institutions? Unfortunately, they have not. They show incrementalism by saying, oh, we have grown by 20%. And unfortunately, then we become the narrative of the Hindu rate of growth, we are doubling. Yeah. I think there is nothing. If we have to take care of our people, there are things that we can learn from China.
Clearly. Gradualism and incrementalism is passé, I think.
And also sensationalism.
And sensationalism is passé. I think it's time for a Big Bang approach. Thank you so much, Dr. Harshvardhan Raghunath and Srinath Sridharan, for taking the time out and dropping by to have this conversation with us. This streams on youtube.com and across the streaming universe on Spotify, Google Podcast, JioSaavn, Ghana, and Earshot.in. Thank you so much. Stay tuned.